So as we were preparing for this, discussion, we asked kind of the panel, the group and the attendees, what do they want to learn? And they want to get down to the brass tacks, really understand some of these more common questions that they find themselves talking to their corporations about. So to shift into that, let's start with structure. One of the first things that seems come up is, do I need to raise a fund like a traditional venture capital would, or should we be investing off the balance sheet? How do you guide companies through that choice as a starting point?
Now, I'll go first here. When we started working with Nicola, he really went for the full Monty. He went to Tokyo. He asked for $50 million. He asked it to be set up as a separate subsidiary. So one of the things I think is so cool about the TDK story, which got chronicled in Forbes, so that was nice for us, but is that Nicola went from being a senior director, one of probably 300, to being one of the 9 presidents at TDK. All right, so as president of TDK Ventures, $50 million separate kind of bank account, as it were, right? So it's not something that if they have a tough quarter, it gets pulled back and things like that, which has historically been a challenge for CVC. But at the end of the day, it doesn't really matter as long as there's kind of commitment and as long as there's the notion that, okay, so Goodyear announced they're going to do a $100 million fund. Xerox has announced $250 million fund. Schneider's got the $500 million. But we work with the guys at Hypertherm, $35 million fund. It doesn't matter at the end of the day because you can fit the corporate strategy with the CVC strategy and deliver the strategic goals. And ideally, if you're doing it really well, you're also going to deliver the financial goals from that perspective. So the structure is fungible. The structure is flexible. You can kind of make any of that stuff work, which doesn't work as well. And I'll turn it over to Scott here. Is the we're kind of on again, off again. Like, this quarter we feel good. We're going to allocate some stuff. Next quarter, not so much. We cannot afford to take on people in those kind of relationships because what we're leveraging are my 20 plus years president of the Western Association of Venture Capital. If we need to go see Scott Sandell at NEA, we'll go over, we'll sit down with him, we'll have a conversation. I can't do that with somebody who next quarter they're going to change their mind. That's not fair to any of our contacts, not fair to me. And frankly, it's not even fair to the company that's doing it. So and I'm sure Scott, drill into people, you got to have a level of commitment here. If you're not going to have a certain level of commitment, then let's just not do that right now. Let's take another year and think about it. Let's work with you on strategic partnering, work with you on some M&A strategy, things like that instead.
Yeah, Paul, I think that taps into probably one of the greatest fears that traditional VCs and entrepreneurs have about corporate VCs is, are you going to be there when I need you? Right. If the answer is, I don't know, they don't want your money, right? So, I think a traditional fund structure is good when you're trying to signal to VCs that you're going to act just like them. But what's more important is that you really do act just like them. And so, sort of when the rubber hits the road and the next round of funding is happening and insiders all have to pony up, do you deliberate the same way? Do you decide to support the company with rational metrics? Are you acting like a VC would? And then they like you as a partner. And if you're flaky or you don't communicate well, then they're not going to like you and you're not going to get invited back into the next round. So I think ultimately behavior matters. On the structural question, Dave, what I think actually matters a little bit more isn't what legal form you pick or what kind of entity from the balance sheet or dedicated fund, but what's the source of the funding? And so, we've worked with where it's the corporate, sort of balance sheet or, comes from the, general ledger versus where it maybe comes from a specific business unit. And I think one of the dangers is if it comes from a very specific P&L operator, that may lead to alignment problems. It may lead to incentive problems. Because what I've sometimes heard CFOs say is, well, how do I punish the P&L operator when they've lost the money? And when that loss, when that write-off shows up on the balance sheet of that P&L operator and it hits the earnings, they may get very conservative in a way that doesn't match up with venture capital. So making sure that the source of funding is aligned with the level of risk that the corporation wants to take is maybe more important than the corporate form. And I see there's a question, we should probably both handle it, Paul, from Brian, about whether we're aware of any corporates that have created a fund with outside LPs. I am aware. It seems to be the exception. It's probably more common in my experience with some of the Japanese conglomerates. And, there's pros and cons. Obviously, the pro is you get leverage on your capital, and the con is now you're responsible for somebody else's money, and you may not be able to pursue all your strategic objectives with full flexibility.